Hello everyone, and welcome to FinWiser Advisory. In this course, we will be talking about financial modeling, DCF and comparable valuation. We are building a financial model on Tesla Motors. This course is divided into 16 modules. In Module 15, we will cover relative valuation. In this module, we will understand what is relative valuation or comparable company analysis, how to build relative valuation matrix. We will be using Microsoft Excel. In this template, there are two sheets named as Relative Valuation 1 and Relative Valuation 2, which step-by-step run the user on how to incorporate relative valuation in the model. Historical income statement, balance sheet and cash flow created in the previous modules are available in this as well. Once the user completes a module, the final outcome of that is available to be used in the next module. Now, let's get started. Relative valuation is like comparing prices to figure out if something is cheap or expensive. Imagine you're shopping for a car, and you see two similar cars. One costs $20,000, and the other $25,000. To decide which is a better deal, you'd compare the features of the cars, like the model, year, mileage, and so on. If both cars are in similar condition, you'd probably choose the cheaper one. In finance, we do something similar, but instead of cars, we compare companies. We use ratios like the EV to EBITDA, which tells us how much investors are willing to pay for a company's earnings. If two companies in the same industry have similar earnings, but one has a much lower EV or EBITDA ratio, that might mean it's undervalued and could be a better investment. Just like the cheaper car might be a better deal. So, relative valuation is simply comparing one company to others like it to see if it's priced fairly. For valuing a company using DCF method, we need the following. For estimating the relative value of stocks, you need to set an accurate benchmark. The companies that you are comparing should be from the same industry, and it's even better if they have similar market capitalization. In this model, let's say that there are 8 companies as mentioned in cell range B8 to B15, which are direct competitor, and we have the corresponding valuation ratios like EV by revenue, EV by EBITDA, and EV by EBIT, in cell range C8 to E15. Next, we calculate the high, low, mean and median value of these ratios in cell range C17 to E20. High value in cell C17 can be calculated using the max function, low value in cell C18 using min function, mean value in cell C19 using average function, and median value in cell C20 using median function. Now source revenue, EBITDA, and EBIT for 2014 to 2016 forecast period and link them in cell range C25 to E27 as shown here. Finally, calculate the enterprise value of business in row 37 using mean value of the valuation ratios calculated above. For instance, EV by revenue mean value for competitors is 10x. And our business has reported sales of $3,749.2 million resulting in enterprise value of $37,491.8 in cell C37. From this enterprise value, add cash and reduce debt to arrive at intrinsic value of the business and further divided the resultant by number of shares outstanding to calculate intrinsic value per share in cell C42. Similarly, you can calculate the intrinsic value of the business based on EV by EBITDA and EV by EBIT ratio using same approach. That's all for now. See you in the next module. Have a wonderful day.